Welcome to the Fear and Greed Daily Business Interview. It's fair to say there's plenty of market uncertainty at the moment, given the state of the local and global economies, the geopolitical situation, the unclear trajectory of interest rates, and what's going on in the bond market. So how should an investor think about building a portfolio? Stephen Tang is Head of Portfolio Solutions at Zenith Investment Partners. Stephen, thank you very much for joining us on Fear and Greed this morning.
Thanks, Sean. Great to be here.
Before we jump into creating that portfolio, can you just give us a quick top line on the macro environment? Because, of course, when we're thinking about investing, we need to know what's going on in the economy.
Yeah, so from our point of view, at least, I can talk about the macro environment. Macro environment certainly has been challenging in the sense that, our view is that there's a soft landing coming. So and that means that the central banks are generally going to be raising rates, but it's not going to cause a recession, which typically is an environment for markets which great, but it's not dire. And so, when we're looking at markets, we take that perspective, but we are conscious that the range of outcomes here is quite wide. So, it's been a pretty volatile macro environment, and we can see that in markets every week, pretty much, depending what's coming through the news wires and what the Fed or central bank is saying will lead the markets down or up. So there's a fair bit of volatility in markets, and we're conscious that that's the reality, and we're trying to work through that. And clearly there's other things going on in the world that is causing some volatility as well.
Okay, so with that as a background, what sort of stocks should investors be looking for?
From our perspective, when we think about asset allocation, we think at a broad level. So we don't talk specific stocks, but we are talking types of stocks that we'd like to buy.
Mm-hmm.
So types of stocks we think would be well benefited for investors is quality type stocks. And when I'm talking quality, what's quality? What quality is companies that have low debt, good balance sheets, in other words, high return on equity, so and consistent, stable earnings, and low debt. So that's really the type of companies you want to be buying in this environment. And if you think back to what I was just saying about that macro environment, if we are going into a higher rate of world, well, clearly debt's not going to be beneficial to you. So too much debt, everyone loaded up on debt when zero rates, but these days when rates are back around 5, you're probably rethinking that decision. So, we want to go and buy companies that are more resilient in that sort of environment, so they don't have to worry about that debt maturity and profile, and that they've got more consistent earnings.
Yeah, so consistent earnings, lower debt. When we buy, or when you buy something, when I buy something, we always talk about valuation. Given the uncertainty, is it okay to pay a bit more if you're buying a quality company?
Yes, with a caveat. So, yes, if you buy a quality company, if you look historically, at least through time, you're always going to pay a premium for quality. No one's going to pay, if you think about the stocks that embody quality of late, you talk the tech stocks, they have typically traded at a premium, and depending on the day, a large premium. So yes, you're always going to pay a little bit more, but you do need to be aware of valuations, and it is an important factor. If we think back to 2021, everybody was quite favourable on quality, and it was trading at a very expensive valuation. So if we relate it back to the valuation component, PE-wise, quality trades on about a 4 times sort of historically above the broad market in terms of the PE. But if we think back to 2021, it was actually trading at about 10 times over the market. And in that case, it was actually expensive. It didn't provide the defensiveness that everybody thought it would. And that's the reason. So today, if we look at that metric, and bear in mind this is a simple metric, it's trading around 6 times above the market. So you are paying a premium for quality, and you should expect to, but you should be wary of the valuation component, because if things get too stretched, if you pay too much for a stock, then you're likely not to be as defensive as you think you are.
What about, well, actually, this is a good time to remind listeners, of course, we're not an investment advice podcast. Always seek out professional advice to suit your needs. What about, you mentioned the big tech stocks, the Magnificent Seven, Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. I know you're not stock specific, I get that, but we just clump all those big 7 together. What do you think of them? Are they, what do you think of them?
It's hard not to have a view, I'll be honest, on that one, Sean, because it's such a big part of the market. And so we have been talking about that a lot internally around they've been driving the market, the US market at least, majority. So if you look at their returns, notwithstanding they've had sell-off, but they were driving the majority of the returns in the US market. If you strip that out, the US market actually had not gone anywhere if you strip out those 7 stocks. So what we would say is that, as a house, we'd be comfortable with people being underweight that part of the market. It's run really hard. Yes, it's quality, but again, goes to that valuation speak. So yes, they've come down, but you just want to be a bit aware. At one point, I remember talking to clients, and it was Nvidia. This is pre-earnings. We're talking to clients around 220 PE. I mean, okay, I think you can say that you should expect to pay a bit more, but probably 220 is probably a little expensive in my view. So
a little bit of bubble there.
Yeah, it's a bit bubbly.
Yeah.
So I think, there we would say be conscious of that. And if we talk around and we talk to lots of active managers, a lot of them are underweight that part of the market. And a lot of them would say, we're looking for things that are beneficiaries of that thematic. And really it was the AI thematic that was driving in NVIDIA. But what other stocks can be benefits of that aren't priced at that level? And that's really what you want to be thinking about at this point. You don't want to be chasing the returns that everyone else is chasing.
Stay with me, Stephen, and we'll be back in a minute. I'm talking to Stephen Tang, Head of Portfolio Solutions at Zenith Investment Partners. So when you say quality companies, I immediately, of course, think of large caps, but that doesn't necessarily follow. What about the small cap sector? It hasn't performed as well. What's your take on that?
Yeah, so we're quite favourable on the small cap part of the market, primarily for the reasons you've just mentioned, which is it hasn't run. The valuations look a lot more attractive in that space. To your point, it really depends on where you're looking in the world for quality. You can find quality in Australia in small caps, but it tends to be in that tech sort of part of the market only. If you go global, you tend to get a little bit more choice in that market. And so global small caps in particular is one of the favourable areas that we think investors should be looking a lot at. You can find quality companies, and it's important to state when we go into a global market, talking about a global small cap is not the same as talking about Australian small cap. A small cap in Australia is, under $1 billion. If you talk a small cap in global markets, it's like a Woolworths in Australia. So it's a vastly different composition of market. So global small caps is not quite what everybody would probably associate with that.
Okay, so we've talked a lot about equities, but of course the portfolio should be more than equities if you're diversifying your risk. What about bonds? Are they attractive right now? I know they've come off a little bit, but they're still a lot better than they were.
Definitely, Sean, you would say that's the case. Again, if you think back, not too long ago, 10-year bond yields were under 1%, 80 basis points or 0.8%. Today, that's a far better picture. And yes, the return profile for those bonds look a lot better. So while we're not super excited about bonds at these levels because of all the macro volatility, we would say that they offer a lot more compelling value than they have for a long time. And in fact, they're around probably fair value, and we'd say we'd be, and we have been advising our clients to increase the bond allocation in their portfolios incrementally. We don't want to make the hero call and say, let's go overweight bonds, because it's been a pretty wild ride to this point. But certainly at these levels, they look a lot more attractive than they have historically. And more importantly, if, and this is a little bit of an if we go into a recession and inflation comes down and central banks cut, which is a few ifs there, bonds will offer that diversification into your portfolio, which they haven't had that quality for quite a while.
Okay, the next asset class I just want to bring up is real assets. So things like real estate investment trusts and infrastructure and stuff like that. Where's your take on those ones?
Yeah, it's been a really tough space, to be honest. We've been talking about that internally a lot. It's the interplay of, particularly infrastructure, where you would say the earnings are linked to inflation. The issue that they've been facing is the real yields that they're all priced off have been going up dramatically, and that's rebasing their assets. So that's been the bigger headwind for those assets. It's a similar story for property, not quite as strong a linkage to inflation, but there's a linkage there. So that headwind of rising real rates has been the challenge for those asset classes. From here, and this is the question we've been asking, like, you're probably closer to the bottom than you are to further falls. So we're probably a little more neutral on that space at the moment, but certainly we wouldn't have expected the sell-off we've seen in that part of the market. So
tricky one.
Yeah, tricky one. Yeah, that's probably the best way to put it, Sean, I'll be honest.
Yeah. And just quickly, we're out of time, but what about alternative investments? Now, that sort of captures all sorts of things that aren't bond equities and real assets, but is there anything in that area that's worth having a look at?
There's plenty, and as you said, there's a lot of nuance in that market. In the liquid space, we have seen returns be better in things like trend following, depending on which strategy you're in. Again, it does get pretty detailed into which strategy you're in, but trend following has been pretty beneficial in a lot of these types of market where they're just trying to latch onto a trend. And, real assets, I think you touched on there, some of those assets have been fairly immune to date to volatility in markets. So I think, some of those assets like private credit, although you've got to be a bit careful in that area, we think that's been attractive. So there's certainly areas in those parts of the market that you want to be investing in.
Stephen, thank you for talking to Fear and Greed.
Thank you, Sean.
That was Stephen Tang, Head of Portfolio Solutions at Zenith Investment Partners. You've been listening to the Fear and Greed Daily Business Interview. Remember, we are not an investment advice podcast, so always seek out professional advice to suit your circumstances. Don't forget to join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.